No matter the type of strategy or method of trading you use, every type of trader needs 3 categories of time frames to determine whether he or she is going to take a buy or to take a sell on a given security. Hello everyone, this is Paul from the Pin Academy, and in this particular video, we are going to be looking at the uses of each time frame. We have done such a video before, but we did not give you guys illustrative videos, and most of you have been coming to our email, coming to the inbox, asking us to do a practical video with examples about the uses of each time frame, because it has really been causing most of the traders issues, right? So just like we mentioned before, every type of trader needs 3 categories of timeframes to be able to determine whether they're going to buy or to sell a certain security, and to make also the analysis easy. The strategy or method of trading that you're using, it doesn't matter in this case. And it's not a must that you're supposed to use the time frame that I'm going to show you here. By the end of the video, if you stick until the end, I'm going to show you how you can determine your own time frames. You're not supposed to particularly stick to the ones I'm going to show you in the video here, or as an example, or as examples in the video. I'm going to show you how you can come up with your own at the end of the video. So make sure you watch until the end, right? So let's start with the first category. The first category is what we call the analysis or structure timeframes, whereby you need to identify what you're trading. Most people do not understand what they're trading actually. Like, you need to know exactly what you're looking for in the market so that you can determine whether you're going to, from what point are you going to enter the market from, or where are you going to exit the market from. This is all determined from the analysis of structure timeframes, which most people actually do not understand. Most of you are using the same timeframes to enter trades, to exit trades. That's why it's very hard for you to become consistent. Why? Because you're not able to realize a good risk-to-reward ratio since you're using the same time frame, and you do not understand the importance of that particular time frame that you're using to either enter the market or exit the market, right? So under the analysis of structure timeframes, we do have the monthly time frame. This monthly time frame here, we do use it to determine the direction of the market, right? The security that you're going to trade, you get its direction in the monthly time frame, right? Just like I said, these time frames that I'm using here, that we use, may not be suitable for you, but we do recommend that you use them, right? But if they're not suitable for you, we are going to, by the end of the video, we are going to show you how you can come up with your 3 categories, and you determine which time frame actually is suitable for you, for the type of trading or the personality that you do have, so that you have those 3 categories. Remember, as a trader, no matter the method you're using, whether you're using ICT, whether you trade price action, many names of and many strategies out there, but no matter which one you're using, you need to have these 3 categories. So like we're saying, monthly gives you the direction. You need to have direction. You cannot just start moving without direction. Whether you're going to work, whether you're going to the gym, you need to know where your gym is located. You need to know where your school is located. So you need direction. The same applies in the market. You do need direction, right? And we have 2 directions in the market. We have the upward direction and we have the downward direction. No matter whether the market is moving sideways, still it's going to move either up or it's going to move down in that channel or in that pattern that it's trapped in, right? So I'm going to be showing you this practically, category per category. Make sure you understand. In case I'm very fast for you, make sure you slow down the video so that you understand each part, right? So the first category of analysis, we have started with monthly. We have said monthly is for direction. I'm going to be taking out a practical example. Those who have been watching us, you know how we do it. We first do theory, we make you understand. Then we go to the charts and we show you what we have done in the theory bit of it. Then the next time frame in this category is the weekly time frame. This one gives us the first structure, which is majorly used by long-term traders, or what sometimes we call swing traders. People are going to hold trades for a number of days or a number of weeks or a number of months, right? That structure, which is formed in weekly, actually is the most important time frame. If you can master the structures in that time frame, it's very hard for the market makers or liquidity providers to really break that structure. I'm not saying they do not break it, but in most cases, the bigger the time frame, the higher you go, the structures formed in bigger time frames, they tend to really be respected, right? But of course, due to the capital of the retail traders, me and you, we have, whether you have 5 figures, 6 figures in your account, this is very little money compared to what the liquidity providers are using. Those guys are trading with billions of dollars, trillions of dollars, right? So the weekly one is giving us a structure. Actually, it's the time frame in which we get the first structure, and it must be communicating with the monthly time frame. Let's say if the monthly time frame if the monthly time frame tells us that we have a W, right? And we know the rule of a W is we're up here, for example, and the rule of the W says that we need to come back to the neckline, right? So if this is what monthly is saying that we're up here, we have a W, we need to come back and retrace this neckline here. The weekly also should be communicating the same thing. It may not necessarily be having maybe a same W or something, but it needs to have a pattern here. By the time you go to the weekly time frame, when you switch to the weekly time frame, we need to have a pattern here whereby it's also telling us to come down. For example, we have a W, this is monthly. Then when you go down to weekly, we do have, let's say, an M, whereby we are the neckline, right? So you know that when an M is created and we have reached the neckline, what do we expect next? To move downwards. So this is already indicating to us that monthly and weekly are communicating the same thing. Let me just repeat that in a different angle. If we do have a W here, a W says, and we are up here. This is where we are. This one here, this area here. If we are here, and the market is telling us I was supposed to be going downwards, right? So this means that when you go down to weekly, also it should be showing us that we're supposed to be going down, but it should not mean that you should be seeing the same structure that you've seen in monthly and weekly. You may see a rising wedge. A rising wedge in most cases, or most times, does indicate that we're supposed to be going downwards. Whether using an indicator like a moving average or using an RSI or using a MACD, but the moment you switch to the next time frame, which is weekly, monthly has given a direction that we're going downwards. Also, weekly should be giving you a structure or pattern that is we're going downwards. For example, here I'm using an example of an M, whereby we are the neckline. So this neckline is supposed to be telling us that we are going downwards. This means that monthly and weekly at this particular time are communicating the same thing. Now, putting this aside, when you go to the third time frame that is in this category here, the analysis and structure time frames, we do have the daily time frame. Now, the daily time frame does give us the structure that is going to be used by the other types of traders like intraday, scalpers. Those scalpers tend to use structures from a bit lower time frames like H4, H1, and they take their entries in the refining time frames, as we're going to be looking at in the upcoming categories, right? So the analysis or structure time frames, whereby we get our structures we trade from, are categorized of these three time frames. The monthly time frame, which gives you the direction. You need to have the direction to determine where you're going. Then weekly structure, that is for swingers. And those people are going to hold trades for some bit of time, weeks, days, or even sometimes a few months. Then daily time frame, which is for intraday, whereby people do not hold for long, or even scalpers who want to trade using those major levels are going to be using, right? So let's try to look at this example of the analysis or structure timeframes. How do you use it practically on the charts, right? Without wasting time, let's just go to the charts. Okay, so this is my monthly time frame. If you look just on my top left corner here, I'm going to be using an example of GBP JPY. So we have started with the monthly time frame. Recall, we are going to be doing this practically. We first start by theory, make you understand. Where you don't understand, you can ask questions in the comment section. So now let's do this, what I explained earlier on. Let's do it just here practically on this chart here. So if you look at this monthly chart, we do have a resistance level here. Now, when we hit a resistance, how do we define a resistance? A resistance is an area or level whereby we do expect sellers to come into the market. So just observe here, right? We do have a market that created a structure here, and currently we're at a resistance. So this structure here was previously a resistance, which the market broke over. So when we break a structure, for example, like this, what do we expect? We expect the market to give us a retracement before continuing upwards. And this is exactly what we do expect from this price movement. The market gave us this turning point here, which is acting as a resistance. And when the market came down here, gave us a turning point, went upwards, came downwards, meaning that we have a turning point here also. Then the market broke upwards. So meaning that we have reached this point of resistance, and we are saying that at resistance, when price comes back at a point of resistance, which is a previous turning point, we do expect sellers to come into the market. So in this particular case, we do expect the market to give us a slight push downwards. To which point? To exactly this turning point here. Someone may be saying, but I don't see a turning point here. If you don't see it, make sure you go to the line chart. You'll be able to see a turning point like this. Remember, I've told you guys once on this channel that if you want to see turning points easily, you use the line chart. And also, if you want to mark points on your chart using the horizontal lines, make sure you use the line chart, because it's so accurate in determining how price closed or the price closure, right? So I'll just go back to the candlestick chart like this. If you want to use a slab to mark the candlestick wicks, make sure you mark it like this and should not cross or cut through the candlestick. body, right? So monthly, what direction is monthly giving us? Remember, we said that monthly is supposed to be giving us direction. So already we are determining that this is a resistance, and currently the market has come back here and we have broken a turning point. So we expect the market to give us a turn downwards. So what's our direction? Our direction is a sell, meaning that whatever we're going to be doing in the lower time frames, we need to be looking for selling structures, right? So let's go down to the weekly time frame, which is supposed to be also communicating to us the same thing. Now, I've not done anything, but the more you go to the lower time frames, you just adjust according to that. Now, if you have to check, also in weekly, we're approaching exactly what we call a resistance, also in weekly, right? Which is aligning properly with monthly. And weekly, now you can clearly see properly that we do have a structure that was acting as a resistance here, pushed the price down. When price came here, tried to act, but price just went through it, meaning that we do have an area that needs to be tested down here, right? So meaning also weekly is communicating the same thing with monthly. Monthly communicated that we need to be looking for sell. Also weekly now is telling us we need to be looking for sell. Why? Because we broke a structure which was previously a resistance, and also currently we have approached a resistance, and we know that once we break a turning point, just like this, when we break a turning point, comes down, this turning point here, once it's broken upwards, we do have to expect a retracement to this point here, which exactly is what we are seeing here. It's easy for us to mark these things like this or to see them on charts, but when it comes to the chart, price movement itself of the chart, people tend to get lost, right? So let's continue down to the daily time frame. Then we say that this structure here is used by people who are supposed to be holding trades for a long period of time, right? Then when you go down to the daily time frame, this is for people who are supposed to be holding the trades or the price movements for at least a day, within a day or a few hours, and then they close. Now, if you to come also to daily, you can clearly see that I've not drawn anything else, just using the same markings I did in monthly and weekly. You can clearly see that they're aligning properly. We do have a resistance here, which gave us a push all the way downwards. Then when the market came upwards, also gave a turning point here. So meaning that the market gave us this push down, gave us a turning point here, push up, came down, turning point, then we broke upwards, right? So data shows that we had a retest in this point here, but also we did create a certain turning point upwards. But overall, you can clearly see that also we are approaching a resistance area. This same resistance area also is appearing in daily, which needs to give us a retracement. Now, this is when you can bring in confluences, but for the purposes of making the video short, we shall speak about that in the upcoming videos, in one of the upcoming videos, right? We do bring in confluences. For example, we have impulsive moves here. The moment sellers come in, you may apply in what we call Fibonacci. We have also spoken about it on this channel here. You may just scroll through the videos and see how we do use the Fibonacci correctly, right? I'll also leave it in one of the cards in the top right corner, so that if you want to look at it, you can see how we apply it correctly. Most people are applying it the wrong way, right? So I think we can now observe how we use these three analysis or structure timeframes, that category of analysis, or where we identify structures from, right? You have to first get the direction, then which you do it from monthly, which I've showed you here. Then you get the first structure, which is given by weekly, which will be used by people who want to take trades and hold them for some time. Can be several days, weeks, or even some few months, right? Then the daily, which gives us structure that's going to be used by intraday traders, right? Or scalpers, those who want to use or want to trade using major levels, right? So this is how we use this first category of the analysis or structure timeframes. Now, you can see all of them aligning. What we have just done, we call it alignment, right? You need to align and know if I'm looking for buys, are all these categories, are all these timeframes giving me a buy? If they're all giving me a buy, that's a high probability trade. Now, if one area is not giving me a buy, yet monthly, weekly, for example, monthly, weekly are giving me a buy, and daily is not giving me a buy. So if daily is not giving you a buy, what must daily show you to also go into a buy? That's where most traders tend to get lost, right? And they start panicking along or trading in between, and they get hit, right? So you need to first do what we call alignment to know the direction, then get structure and make sure the two structure timeframes are aligning, weekly and daily, right? Then after that, you'll be able to choose, are you an intraday trader or you're a long-term trader who is supposed to get a structure from weekly, or you're a short-term trader who's supposed to get their structures from daily, right? So that's the first category. I really hope you've understood it properly. Let's now switch into the second category. So switching or coming to the second category, the second category we do have when you're a trader and you must have is what we call the entry timeframes. Now, there are very many timeframes that you can use as a trader to take your trades, but the ones we do recommend, like I'm saying, that these are the ones that we do use, and also we do recommend you to use. But at the end of the video, what is suitable for you, it may not be suitable for me. What is suitable for you may not be suitable for me, and also the other person. So I'm going to show you exactly how you can choose your own time frame. So make sure you just stick until the end, right? So the entry category, the entry time frame category is supposed to, after you choosing, remember what we have just done is what we call alignment in the previous category of monthly giving you direction, weekly giving you a structure for long-term trades, daily giving the structure for intraday and a bit of short-term trades, right? Now, after that, after choosing, you're supposed to determine what time frame you're supposed to take a trade in. I've always mentioned in the previous videos that certain timeframes are not suitable for taking trades of or trading on structures of certain timeframes. For example, you can, but for example, it's very, very inappropriate to use H4 to trade a daily structure. Why? Because H4, one candle has 4 hours, yet a day has about 24 hours. So if you have to check, you just need 6 candles to end the day. Now, some of you trade candlestick patterns. By the time we are forming a candlestick pattern, for example, a morning star does have 3 candles. For example, it has, if you're using H4 on a daily structure, it has a 1 candle, then it has a middle candle here plus another candle here. So these are how many hours? 1, 2, 3. This is already 12 hours that you've wasted here, right? And now, by the time it's moving to reach your target, it's already halfway. You have a bad risk to reward ratio, and also you may have a very huge stop loss, which is not suitable for that time. That's why I'm saying your analysis time frame or the analysis category where you get structure from must properly be aligning or correlating properly with the entry time frames that you choose, right? So when we come to the entry time frame category, which time frame do we have? The first time frame we do have for entry is H4, and this category is used by the people who are going to hold trades for long. This one is used by people who get their structures from the weekly time frame, who are going to trade the weekly category. And these ones, we have said already, they are swingers, or they hold trades for a number of days, or they are holding trades for at least a longer period of time compared to other types of traders, right? Then the other category of entry, or their time frame for entry you can use is the H1 time frame. Now, this one is suitable for people who are trading in the daily time frame, who are getting their structures from the daily time frame. Now, before we go to the charts to look at examples. Now, so far we have put 2 things together. We have gotten the structures, we have gotten the direction. Monthly gives us direction. Then after that, we do go to let me just write it here properly where you can see. We have gotten the monthly, where we said we get direction from. After then monthly has given us 2, which is weekly. Then the second one here is daily. Now we're saying that we're taking our entry of week, we're taking it from H4, and then here daily we're taking our entry from H1. Reasons why we do this, I've explained. Weekly is a bigger time frame, meaning weekly, if you're trading normal the normal markets, which has forex, that's currencies, and commodities plus others, you can see that it has 5 days. So, and how many H4 candles in a day? 6. So 6 times 5. Those are the number of H4 candles that you're going to be having there, right? Then the daily time frame, it has 24 hours, and how many hours are there in a day? There are 24 hours. So it means that it gives you enough space to be able to get a proper risk to reward ratio for your trades, right? So this is how we so far stand. If in case we are drawing something like a link tree here, this is where we stand. Weekly, you're supposed to be taking trades in H4, and daily you're supposed to be getting your entries in H1. Direction, you can choose either, let me just change the color here. You can choose either to go like this, get the direction, go to daily, then do this, or you can choose to go, let me just change the color so that it can, or you can decide to go with this side here. If you're a swinger, you're taking weekly and you're using H4 to take your trades. Now, let's try to combine these things together with the example that we already had, right? So let's try to go back to the charts, and we use exactly the example that we had done. We have gotten our direction that we had a sell on GBP JPY. Weekly was stating a sell, and the daily time frame also was stating that we're supposed to be looking for a reversal. Now let's try to go and we try to put in the H3 time frame, which is H4 and H1 for both situations, right? Let's just go to the charts. Okay, so this is our chart, which we were using for the examples that I showed you earlier. We did with it the structure category. So we're just going to continue from here. Remember, we have gotten the structures. We have gotten the direction that we're looking for sales. Now we got the structure in weekly. We're also looking for sales, the bigger time frames. And the weekly people are planning, if that to get entries, they're going to take entry from this point here. And this is their target, right? Remember, we do this in a weekly. Now for the daily people, when we're to get our entries from here, what's going to be our target? Our target is going to be this area here. I'll just change the color to blue. So this blue one is the target. Remember, we said we are getting targets and structures from the analysis timeframes, while we're getting entries from the entry timeframes, and we've already looked at them. So today, right now, we're just adding in we're adding in the entry factor or the entry aspect to the already existing structure that we have created. So I'm going to give you examples of both the weekly and the daily people, how they would be treating their entry. So let's start with the weekly, guys. So let's go back to weekly. Remember, we said that weekly here we also have the resistance. This resistance here, this is the weekly time frame. So since we're at resistance, we are going to go to our entry time frame, which is H4. So we're going to wait until the market does give us a trade. From here, then we're going to be targeting this green area. Remember, the target of a swinger and the target of an intraday trader is different, right? And also the way they take their trades is different. Why? Because they're differentiating in the entry time frames. We have said H1 for daily time frame and H4 for the weekly time frame. So since we're in H4, which means that our target is going to be this one here. So let's try to see what exactly the market does give us. So the market does create a structure here, and this is what we're going to be using to take our entry. So let me just change it to red to differentiate from daily. The blue color is for daily. Don't forget that. So I'm just going to be using, I'm going to use daily, the red color for the weekly, guys. So the market is still here. When it breaks this point here, why? Because this is the market moved aggressively up, creating a high, higher low, equal highs. So we need this higher low to be broken so that we can be looking for a sell, right? Of course, I'm not going into details for how we take entries. I just wanted to incorporate in the importance of the timeframes, since the video is about the uses and importances of each time frame and how you can use them, right? The entry part, how you can take good entries, we shall be making them in upcoming videos. So let's check what the market does. So this point, the market breaks here. Now, people who are aggressive or who have enough capital may decide to take their trades immediately after the market breaks out of this area here. But if you're conservative, which most times may lead you to missing trades, you may wait for a little pullback. So we're just going to take our trade from here, and we're going to have our stop loss just above this longest rejection here, and our target is going to be down here, right? So I'm just going to adjust this, but just like I've mentioned, I want you to look at the risk to reward ratio, which most people are going to be focusing on. If you're just going to take your trade from this point here, from this point here without a small pullback, you see the risk to reward ratio, which is not the one that we do recommend. The minimum risk to reward ratio we do recommend is 1 to 2, but the most favorable one is 1 to 3. So to avoid this, what are we going to do? We identify a structure up inside this double top here. For example, this is a double top that we're using to take the trade. Of this double top that the market may not go back beyond or may go to retest but not break it. So inside there we do have, let me just increase the size of the candlesticks. We do have a candle here that the market may go and test but may not break. So I will just adjust my stop loss slightly above it to give me that. And then also I know that the market is going to come into this area here. So I'll adjust depending on how you trade, the risk to reward ratio that you do use, right? So this is how the weekly person is going to use H4 to take their trades, right? So this is it. Now let's go and look at also the aspect or the example of the person trading using the daily time frame, right? Who is getting their structure from the daily time frame, right? So I'm just going to play this. Let's check how the market played, right? So let me just run it down here. The internet is a bit slowing down. It's a bit slowing down. Let's just see how it played out. Okay. It's a bit taking time to load. I don't know why. This is trading view slowing down. Let's try to just take it back. So if it is this trade is still running, it means that the trade is still continuing because this is the current price. You can see it moving here, the current market, right? The time in my country is this. So it's still moving, right? Now, let's take an example. Let's assume that we're using the daily time frame to take our trades, right? So I'll just go back to daily. I'll go back to daily, and then I'll take back this in time just here, right? So remember I said that also daily is at a resistance. Let me just delete this. Daily is also at a resistance here. So, and what's our entry time frame for daily traders? We're going to use H1, but don't forget that the target for weekly was this one here, but the target for daily was this one here, right? So meaning that the distances that we are covering in daily is this, while the distance for the swing traders is this one here, right? So I'm just going to switch to the daily mode, which is this target, which is the blue level here. So I'm just going to go to our entry time frame, which we have all agreed is H1, right? Why? Because the hours that the market takes in a day can be at least handled by H1, because there are many candles, or there are more candles in a day compared to the number of H4 candles in a day. So H1 favors more of the intraday guys compared to H4, right? So still, again, we do have a market that created for us a high, higher low, high, higher low. You can see the market came back here. So if the market takes out this low here, then we can be looking out for our trade. So let's see what the price does. It comes back, respects this area. This means that it's a bit a strong level. So let's see what the price does. So this is the first time that the market closes below this point here. And like I said, some people are aggressive. They will take their trades from here. But those who are a bit conservative will wait for a small pullback. But remember, this time around, your target is just this blue area. And what are we going to do? We're going to look for a structure that the market may go to test, or when it goes to, it won't break. So this will be just our stop loss will just be slightly above the structure here, because then that the market could go back to test. And so we already have our decent risk to reward ratio. So let's see what the price does when we're using the intraday, right? So does move, and let me just extend here and see. It misses our target just by a little bit, but the price is still going on, still. Trading view has paused. I don't know why it's doing this a lot today. So this is the difference between a swinger or the bigger structure, which we have gotten in weekly, and the swinger time frame, which is weekly, and the intraday structure time frame, which is daily. And also, you have seen the difference in H1 and the entry time frame of H4. The rules are the same, of which you're going to be using to take the trade, but you've seen the difference in the importances. The difference in the importances of those two time frames, right? And how we use them. The rules are the same, but the importance of how you're going to use it is different, right? So that's the second category of the entry category. But now we do have a third category, which does help you to get a more and much better entry. And that category is the one we call the refining timeframes. Just like the name suggests, it's called the refining timeframe, right? So let's first go back to the board, whereby I'll explain to you what timeframes are there in the refining timeframe, and then we shall come back to the chart and see how can we refine our entries, right? Let's just go back to the board. Okay, so this is our last category of timeframes that a trader needs to incorporate. It's not a must, but if you want to have a better risk-to-reward ratio, in case you're a trader who wants to be a bit professional, not a bit, but you want to be professional and you want to do it as something long-term, you need to always have a better risk-to-reward ratio. And the only way you're going to have a better risk-to-reward ratio is by having top-notch entries. The entry timeframes may give you a good entry, but after getting an entry area, because the entry timeframes do give us entry areas, while the analysis timeframes do give us the structures and areas of interest. So these refining timeframes are asked to give us a better risk-to-reward ratios. How? By getting us earlier entries, not bad earlier entries, but good earlier entries, because you're getting them within the areas of entries which are provided to us by the second category, which is the entry time frame. Now, let me just draw for you our chart so far, how it looks like. Remember, we said that monthly does give us the direction. Then monthly did give us two time frames, which time frames were there? We had the weekly, and then we had the daily time frame. Then when you come down, now we did have the entry time frame, which was H4 on weekly side. And then when you come down on daily, we did have the H1. So we have finished this category. We have finished this category of time frames. I think you can see how we are going downwards. So the one that is left down one here is what we call the refining category of time frames, whereby a trader needs to refine their entry and get a better risk to reward ratio. Most traders do not focus on it. It's just like in business, whereby you're not focusing on how much was my input and what will be my profit margin. How do we get profit margin? It's the total of the sell, right? If let's say I input $10, then the sell plus the extra that we get there. For example, I sell something for let's say I bought it at $10 and I sell something at $18, right? This $18 includes my capital that I input, which is this $10, plus the extra, which is the 8. So it will be 18 minus the capital to get the $8. This is how business is supposed to be. But most people do not tend to focus on this, and they think trading is different, right? This is why most people are not becoming consistent. You're supposed to treat trading exactly like this, like a business, right? That's why most of you are not focusing on risk to reward ratio, then you end up trading. I've seen most people having trades one-to-one. Now, one-to-one is not bad. Okay, it is bad. Let's speak the way things are supposed to be. I shouldn't sugarcoat things, and then you have a long path to your consistency, right? It's bad. Why? Because when you risking one-to-one means that you're going to be risking $100 to get $100. Imagine you go in a losing streak. It's going to happen. You can take two trades and both of them become losing trades, right? It happens to every professional trader. It happens to me. It happens to anyone else who is trading for a living and trading as their daily activity, right? Even if not daily activity, but if it's what brings in income to them, right? So now let's go to the last category here that we're supposed to fill in here, which is the refining timeframes. Now, which refining timeframes do we have? We do have the minute 30, we do have minute 15, we do have minute 5, we do have minute 1. Now, shockingly, this is what most people are using as the entry timeframes, right? So if you've been using this as your entry timeframes, what has been your actual entry timeframe? That's why you see most of you are taking trades. You either get early entries or you get stopped out and the trade goes into your direction. Why? Because you do not have an actual area of entry, which is supposed to be given to you by an entry time frame. Now, for our case, we did have two entry time frames, H4 for weekly structure and H1 for the daily structure, right? So you're skipping that part of an area of entry and you're going straight into these smaller time frames without having that area of entry. So you take a trade and the market wipes you out because you do not know exactly where you are, right? I've drawn for you this flow. The flow chart is like a flow chart whereby you start from direction, you go to structure, you go to the entries, then you come to the refining. Most of us do not have that, right? Now, all these timeframes are refining timeframes for the daily structure, right? Now, someone may be saying, what about swingers? How do you refine? Now, I didn't put it here because it will, most of you think that also swingers who are going to hold trades for long are going to be using this one for refining. No. Remember, a swinger is going to hold trades for days and even weeks, even some few months. So you cannot refine your trades in minutes, right? So a swinger is going to refine his or her trade in H1, right? Swingers do refine. They take entries in H4, but refine in H1, at least to have a more better entry. But when a swinger goes far into minute timeframes, the higher chances are going to get misled. You'll either take an earlier entry or you'll lay in a drawdown, right? Of course, swingers, their mindset is strong enough. They're prepared to be in trades for a long period of time. But sometimes when you overstay in what we call a drawdown is when you're staying when you're in negatives. You've not hit stop loss, but you're still in negatives. When you stay in negatives for long, it tends to affect your psychology, right? Or your mindset. And then you end up making irrational decisions, right? Because every trader faces that time whereby either you're in profit for some time, it's not hitting your take profit, or you're in loss for some time, not hitting your stop loss. So that brings in what we call our trade management. Of course, also for another day, if you're not talking about it today. Of course, today we're focusing on the importance of these timeframes, right? So the refining time frame of swingers is H1, and then the refining time frames of intraday, scalpers, and all that. No, so also scalpers, this is the time frame that they do use to take their trades and set their stop losses, right? Because they are going to stay in the market for a few minutes or seconds or just not more than very many hours, right? So this is how you lay out your trade structure and your trade flow chart, so that you start from the direction, you go to the structure. Where are you getting your structure from? After getting your structure, where are you getting your entry area from? After getting your entry area, which one is giving you a better risk to ratio, which we call refining, right? So which time frame is refining for you? Now, even if you're a scalper, of course, scalpers are taking most of their trades in these refining timeframes. So you get levels, you know that I'm trading between here and here, starting from daily at least, then or even H4 to mark at least those you're aware of. H1, sorry, you're aware of some minor levels of H1 and H4 that you're going to trade within, right? Which one is going to act as your resistance level, which one is going to act as your, because for scalpers, those timeframes are giving us major levels, right? Because we're going to take our trades for a few minutes. So meaning we're going to be taking trades in minute timeframes. Are you getting it? So this is our last category of timeframes, and its importance is to increase our risk to reward ratio so that we maybe we may be able to make more profits. So, or if we're going to make a risk to reward ratio of 1 to 4, if you refine properly, it may make you maybe 1 to 7, 1 to 8, or 1 hour extra, which is also good in the long run, right? So this is theory. Let's also look at it on the charts. How can you be able to refine your trade so that you're able to get a higher risk to reward ratio, or you're able to get a better risk to reward ratio? So without wasting time, let's just go to the charts. So I'm just going to use an example of the daily one that we did last, so that your brain remembers the last example we did. So this was the H1 entry. Now we're going to refine it using the same way we refine for H1 is the same way we refine for swing trade structures, but just that now the difference is in the time frame you're using to refine. If you want to refine an H4 entry, which is a swing entry, you're going to use H1. But when you're refining a daily structure entry, which entry time frame is H1, you're going to be refining in minute time frame. So, for example, this entry of ours was H1, so we're just going to refine it in minute time frames. Now, the first thing that you want to see is the market losing momentum, right? We want to see a loss of momentum. For example, here we have spoken about loss of momentum for in most of our videos, and also we have a dedicated video specifically for it. So make sure you look through our videos and watch it. So we do have a loss of momentum here, and also the market creating for us a structure here. So now, when you see the market losing momentum like this, what are we going to do? We're going to go to the next lower time frame, which is minute 30, right? And then we do observe it clearly. Now, where I was mentioning to you that there was a structure, you can clearly see this. So we do have a rejection and a structure. So this is what the market has created: higher high, higher low. This structure here that we saw in the H1 is now clearly being shown here. It's a higher high, higher low. So now what do we want to see? We want to see the market at least creating more structures, but this time in minute 30, right? So I'm assuming that you did not take this trade from here, right? I'm just going to delete this, but you want to take this trade from here, right? So the structure here is still above here. We cannot take this trade from here. So let's check until the market breaks below it. Still it is above, right? It attempts to break, but it fails, right? Now this is the point at which the market creates for us a structure. Why do we say it creates for us a structure here? It created a higher high, higher low, higher high, came back here to retest this high, and then went back and failed to create a new high. So this is a communication that we're no longer interested in going upwards. So the only thing that is left is for us to break downwards, right? So let's check what the market does. So this is the point at which we're going to be looking for our trade here when the market closes below here. It still didn't close below. Let's just check where it closed, when it closes below. So this is when the market closed below here. So we shall be taking our trade just from here. This will be our entry here, right? This will be our entry. Let me just adjust this properly. Our entry will be here. Now, let's go back to H1 and check what H1 is doing. Now, we can clearly observe that if we're to take our trade from H1, it means that we have not yet entered this trade because this is the structure in H1, this candle here. Are you guys observing this candle? It means that we have not yet entered this structure. Sorry, we have not yet entered this trade. Why? Because we have not yet broken this structure. We need to first break below this structure, then we can take a trade. Meaning, by the time it breaks, the person who has refined here will already be in this trade. I don't know if it makes sense. Let me just repeat that. We who refined in minute 30, we're already having a trade here, right? Because we've already closed below this area. But anyone who's going to take a trade in H1 without refining is going to wait for the market to break below here. Then they will take their entry below this point here. So let's just try to check here. So let's just check and see where your entry in H1 would be. So let's just continue down. Let me just replay it here. So you see, I've already taken a trade here, yet this person is already in the trade. Of course, may run a little bit of a slight drawdown, but we'll have a better entry. Now, you can clearly see that this is the first time that this market is breaking below this point here, right? This is the first time it's breaking below here, meaning that your entry is going to be here, or maybe after a slight pullback, then you'll have an entry. But this person will already be in the trade, maybe even will be looking for a second trade because the market could have hit their 1 to 3 risk-reward ratio, and then they even look for another opportunity. While for you, you're still waiting for a minor pullback or for a retest of structure that the market broke. For example, the market broke this structure here and then broke it from here. We're waiting for a pullback, and this is the point the market made a pullback. This person could have already hit their target or their risk-reward ratio, or they could even be taking more entries, while for you, you're still taking your first trade will just be at this point here, right? So this is how we bring in the aspect of refining to get a better entry. I really hope it makes sense to you. If it doesn't, just watch it slowly, and if you still find it hard to grasp it, maybe you can just tell us in the comment section exactly where you're finding hardships, or even you can send us an email whereby we shall be able to make more videos to be helping you. Now, just like I said at the start of the video, if you watch until the end, I'm going to teach you how you can determine your own timeframes, from structure from determine direction to structure, and also entry, and also refining. So without wasting time, let's go back to our drawing board, and I can show you how you choose timeframes, right? And also you'll be able to see how we chose. If you choose daily, you're going to use H1. If you chose weekly, you're going to use H4. Let's just go to the whiteboard so that I can show you. So if you guys notice that we do use monthly for our direction, then after monthly, we do go down to weekly. Then from weekly, we have a daily, right? These are the major timeframes that we do use. Then from there, you do skip one time frame to look for an entry. Here, you're skipping the daily time frame to get your entry in H4. And then for daily, you're skipping one time frame, which is H4, to look for your entry in H1. So here is the trick. If you're not comfortable with these time frames, if you see they are very big, because some people tend to say that those time frames are very big, I will not be comfortable with them. So let's assume that you would like to use, some people want to use daily for their direction. So if you're to use daily, meaning you'll be having H4 and H1 as your alignment timeframes that are matching together with the direction timeframe. So direction from here, then the next bigger time frame is H4. The next one is H1. So H4, to take an entry, you're going to skip one time frame, which is H1. Then you'll be taking your entry in minute 30. Then H1, you're going to skip one time frame, which is you're skipping here H1. Here you're skipping minute 30 to get the entry time frame of minute 15, right? So the trick is just when you want to get an entry time frame, make sure you skip one time frame. For example, H4, the next one is H1. So we shall skip it. We shall skip H1 to give us the entry of minute 30, right? So if you're getting a structure from H4, your entry time frame has to be minute 30 because you're skipping this. If you're getting your structure, let's say from H1, what time frame are you skipping? You're skipping minute 30. So meaning that your entry time frame is going to be minute 15, right? So you skip minute 30, your entry will be in minute 15, while this one, your minute will be, your entry time frame will be minute 30. So this is how you do get you do choose entry time frames, and also how you do choose time frames in which you get analysis from, and also you align from. The first, make sure you always have the directional time frame. So the direction time frame, let's say you've chosen daily as your direction time frame, the highest time frame you can go to. So the next ones, all the next time frames, the next 2 time frames are the ones going to be providing for your structure. If you choose daily, for example, the next 2 time frames are H4, right? And then the next, of course, there's H12 here. You can also, some people can choose H12. There's H12, there's H8. It's okay. You can choose them depending on how you choose, you want to operate. But make sure after this, when you're choosing the entry time frame, you're skipping 1. So the next, you skip 1, the next time frame to, let's say you've chosen H12 and H8 for your structure. So here we shall skip H8, then your entry time frame will be H4. If your structure here is, your structure time frame is H8, you're going to skip maybe H6 to give you the next time frame like that. That will be your entry time frame. So this is how you do choose entry time frames and also refining time frames. But all in all, make sure you have 3 categories, right? And which categories are those? Categories include analysis of structure time frame, entry timeframes, and refining timeframes. As a trader, you need to have these 3 categories of timeframes. Without that, I'm not saying you're not going to be consistent or you're not going to be a profitable trader, but you're not going to be organized. As a trader, you need to be organized. That's why they say you need to take journals, you need to review your mistakes, you need to have the same method of trading that you need to just be improving on. Do not go from one point to another. So you need to be organized. And organization starts from time frame. One of the biggest reasons why traders are not consistent is time frame. So I really hope this video does make sense to you and you find value out of it. And if it does, do not forget to give us a thumbs up button. And also, if you're not subscribed, on this channel, we do provide videos of such caliber and do give value to this extent. So you can just click the subscribe button so that you don't miss the next upcoming videos. Have a great time.